Good afternoon. This is Jim Barlow. Happy to be with you. Jim Barlow of OakTree Premium Finance. We got back Sunday from a week with our daughter Annie in Kauai. Enjoyed Kauai and enjoyed relaxing, doing some snorkeling and whatever, everything. Anyway, let's go to work. The transforming life insurance into a powerful wealth building tool. Maybe some of you are attending today as a review. Probably most of you are just seeing what this is all about. Happy to help. For centuries, alchemists sought to transform lead into gold, unlocking wealth and enlightenment. Well, I'm the alchemist of leverage. I'm going to show you how life insurance can be transformed into a powerful wealth building tool. By the end, I'm going to give you some tools to show you how you can learn more and become a modern alchemist yourself. So welcome to the new alchemy of wealth creation. My wife is Barbara. We've been blessed with 7 children, 28 grandchildren. I graduated from BYU. BYU won the other night. We remain devoted fans. We're going to be devoted fans Sunday for the Utah game. Oh, Saturday. I worked as an investment advisor for 35 years. Our passion is we love to travel. We do a lot. We visit loved ones. We enjoy family vacations. We read a lot. We attend plays. We treasure time with our family. We serve in this temple and strive to be disciples of the Savior. Above all, we want to continue to do good and help others. You know, it sounded a little quirky to have a transformation and alchemy and alchemists. It really is happening today. We're seeing so much alchemy. The internet, smartphones, cloud storage, online retail. Think back, was that long ago that we didn't have these things? AI, self-driving cars. Oh my. Biotechnology. I hope they have lots of cures for stuff. Online education, solar panels, electric vehicles, quantum computing. It goes on and on. So this is happening. There are better ways to transform things into something better. So again, transforming life insurance into a powerful wealth building tool. I'm going to blend life insurance, a growth strategy, and leverage into a powerful alchemized approach to exponential wealth building. I'll give you some numbers so you can kind of get a feel for it too. A few years ago, I discovered a company in Texas, NIW, and they had built this strategy. They call it Kaizen. They say, we're going to give you more money. We're going to give you more protection, with more confidence. And I agree with all those things. I think this is a cool blending of that things. The word Kaizen is a Japanese term, continuous improvement. They're continually tweaking to make Kaizen better than it can ever be, all the time. It can be used, this strategy, the core purpose is personal and family use. Create more retirement income from less. Tax deferred with no required minimum distributions. Number one means this is the number one reason people buy Kaizen. Number 2 reason, just plain old life insurance. Protect their family's financial security. At the same time, have something building up for retirement. And disability and long-term care, these are riders added to it. So you're covered for these family issues. Safeguard assets for trust-owned creditor protection. You're putting something aside that creditors can't touch. And a terrific way to transfer wealth to family, a better way. These are the family and personal uses. There's also some business uses. Attract and retain top talent and with executive benefits. Number 5, provide succession and continuity liquidity while protecting ownership with funded buy-sell agreements. That's number 6 reason. Safeguard vital executive and key persons. So it's a number of business uses also. And there's some advanced high net worth uses. Number 8, shield estate from estate taxes. And part of number 4, equalize inheritance for family businesses or farms. And there's other reasons. Anyway, it's one strategy with many applications, all designed to give you more security and more income and more impact for your life. This is I've kind of brushed on these in the last one, but it's going to give you more retirement income, less out-of-pocket costs, tax-free retirement income, no downside market protection or living benefits, minimum financial disruption, 5 annual payments or a month, 5 years of monthly payments, simple low maintenance design, creditor protection, strategic gifting to family. It's just another way to kind of go over the same things. Is Kaizen is right for you? That's the question you're going to be asking. The typical range of age is 18 to 65. Applicants must qualify for standard or better health. Financial strength, recommend a minimum annual income of $200,000 to be able to afford these contributions. The contribution levels are $20,000 to $40,000 a year, depending on your age. And then a commitment, a 15-year structured plan. 10 years of fundings, and then 5 years of growth. If you're not ready or you don't qualify today, you could buy a convertible term policy that reserve your future Kaizen opportunity. Just another angle. So let me get all the details. First, life insurance. 4 big bullet points here. Death benefit. It is life insurance. 2, there's living benefits against terminal illness, chronic or critical illness, or long-term care. I think that's a reason for a young family to buy this in and of itself. Then become the tax benefits. The Revenue Act of 1913 is the act the government put income tax in our economy. That's how long we've had income tax. And with that bill, they made life insurance, the death benefits are tax-free. Been there from the day one. And related to that, the cash value grows tax deferred. And you can borrow from the policy tax-free. That's how we're going to give you a tax-free retirement income. And there's no investment advisory fees and almost no management fees. Wow. There is life insurance fees. Maybe I should put that on the slide. The strategy overcomes all the life insurance costs. Anyway, that's the 4 major benefits of life insurance. I have a summary page that I'm going to keep pulling up after each section. Just summarize. Life insurance strengthens financial security, minimizes tax exposure, eliminates tax, and eliminates hidden costs. We're going to go over the next two and we'll add to this laundry list. We're going to use a hypothetical insured person, age 45, male, excellent health, non-smoker, annual income 240,000, retirement saving already at 500,000. He's willing to invest 50,000 a year for 5 years. He wants to start receiving distribution at 65. He wants to continue through 95. Trivia: the average person who buys Kaizen is 46. And the average, how much they put in per year, isn't 50, it's 70,000 a year. So this is close to the average. We're going to use a growth rate of 6.45. This is regulated by the NAIC, National Association of Insurance Commissioners, not regulated by the federal government. It's regulated by individual states, and they have formed an association to put regulations so everyone's kind of following the same game plan. Going to use an income tax rate of 37%. We're assuming this a high income person. We're going to have a long-term capital gain rate of 20% in this example, and we're going to use a state income tax of 5.5. And we're going to show you some numbers so you can compare this with other options. Let's get started. So here's our first number. If we got 6.45% on an average in a regular investment account, after tax I'll call, then you could start a distribution for the 50,000 a year for 5 years, a distribution of 37,699 starting at age 65. And through 95, you'd have 1,168,659 of money you pulled out. And we had used every penny. If we did it in a IRA or 401k, you'd have $10,000 more per year, 47,842. That is alchemy at work. 401ks and IRAs, tax deferral, can give you $10,000 more per year. Okay, we're ready to show you the growth strategy. Growth strategy, we're going to use an indexed universal life. Interestingly enough, indexed universal life came out in 1997. It's not that old compared to term life insurance and whole life insurance. It's a new wrinkle. That's 28 years, but I love it. The reason why, look at the features of indexed universal life. Growth with protection. Cash value grows in the insurer's account with index options providing potential gains without downside market risk. And a negative 20% year in the market, you get zero. I'm okay with getting zero in negative markets. Don't want to have them every year. So growth, potentially market returns with zero downside. I love that. And I'm going to give you more detail, but they have indexed options for where you want to invest. If there's some options that are capped. If you do the SP 500 index, you would have a cap. Currently, most companies are about 12.5%, meaning that if the market did 15, you'd be capped at 12.5. If the market did 10, you get 12.5. So no downside, but capped. But then there's another type of indexing you can participate in, and it's called a participation rate fund. Here you earn a portion of an index growth fund. Interestingly enough, when I said earn a portion, you're probably thinking, ooh, 90% or something. Or actually, most of these are about 200% plus today. So if the index does 5, the participation with 200% would get 10. That's the area I like them both, actually. So market growth with no downside, captive participation, minimal management, annual decisions, turnkey, easy, don't have to worry about it. That's the features what an index universal life brings to the table. So let's explain how they don't have a downside. Majority of the premium is allocated in insurance companies' general account, which consists of high-grade bonds. A smaller portion is given to the option budget. Here's an example on a 5% interest market. You have $1,000 put into the general fund, put into the company for the insurance policy beyond the insurance cost. 592 goes into the general fund, 48 goes to the option budget. They buy options to replicate the Standard Poor 500 or these participation funds, knowing that the 952 grows to $1,000 a year from now. So on every anniversary, you can change your investment options, but you're guaranteed from year to year your principal. You can't lose money. If we're in a 15% interest market, they have more money for the option budget, and therefore they can get more participation rate or a higher cap rate. And so higher interest rates are not initially that bad for a universal life policy. Main thing is no downside, market rates. Hope that was helpful. So here's the summary on our growth strategy. Downside protection shields from market downturns, and market-linked growth reduces investment risk. They're really tied together. And last, we're going to go into the leverage. Little interesting history. Before 1934, mortgages required 1/2 down and 1/2 repaid in 5 years. Whew, I didn't know that until a while ago. I wasn't alive in 1934 or in 1920 when that kind of mortgage was there. Then in 1934, the FHA created the 30-year loan, which revolutionized home buying. We're all blessed by this. Before 1934, about 40% were able to buy a home. 2024, 66%. More than 50% more, higher, a lot more. 85 million residential mortgages are currently outstanding, totaling 12.6 trillion. Mortgages, what a blessing. And I'm sure you'll agree. So, how do we use leverage in our society? We use it for home ownership. We use it for real estate investment. One of my sons bought a beach property recently on a mortgage. He did it primarily for investment, real estate investment. He'll also use it. Maybe I'll get a chance to use it. We use leverage for business, buying a business. Businesses have to, they need money and they don't have it. And for investments. We use leverage for education. Those are positive reasons to use leverage. Some negatives, use leverage for buying a car, transportation, something that's going down in value. We use leverage if we have to borrow for health care. We do it for everyday essentials on a credit card. Hopefully we're not paying any interest there for major life events. And when we were in Cabo, now it's a couple of years ago, we had a photographer. We hired a photographer to walk around the beach with us, taking pictures of Barbara and I. And it was fun. And these are some of the better pictures. Some of them aren't that great. But anyway, there's some pictures we took on our Cabo vacation in 2004. I have a question. Why are we not using leverage for retirement? You're probably saying, well, I didn't know you could. How do we use leverage? Well, I think we need to stick retirement planning and asset leverage into that category. And I would say it's a positive thing. I'll show you the details. So banking, borrowing or leverage up to 3-to-1. 3-to-1 leverage is very conservative. Banks do about 20-to-1 leverage. And you can do a lot more. You can get a lot more aggressive. So we use 3-to-1 leverage. If you're putting in 100,000, we get a bank to put in about 300,000. 5 annual payments or 60 monthly payments. So a short period of time, really. You're not going to make these payments forever. We do it in a trust ownership. This trust ownership provides you creditor protection and allows us to do this loan with this bank without lots of complexity on your part. You know, there's a lot of things we do to this Kaizen to have this thing work. And I try to list some of the other things, but we're not going to go into them today. But I really want you to understand the 3-to-1, 5 annual payments, trust ownership. Here's how it really works. There's the silver pigs are your 5 annual payments. At the same time, we get a bank to approximately pay in the same amount of what you're paying in for the first 5 years. After 5 years, you're done. No more payments on your part. The bank continues to make the payment they were already making, plus they now make the payment you were making. It's almost a visual of 3-to-1. That's the funding of over 10 years. All without the typical risk of borrowing. No credit checks. You weren't borrowing. No loan documents. You weren't borrowing. No personal guarantees. No signature on a loan. No collateral. Wow, I probably should put a wow in there. Okay. The trust and the way we build it allows all these things. So it makes it much simpler and very turnkey. Leveraging historical performance. The very first policy was issued in 2012 by one of the owners. One of the owners' policies. That's why we can get the information so readily. And Kaizen puts out an annual statement. And this information came from the June 26, 2024 statement. I haven't complained to NIW, but they should be showing us the June 25, but they haven't posted it yet. So here's how it's looking. The average return on this first policy through June 26, 2024 is 7.73. Not bad. I guess I should put down the SP 500 in the same period of time. I'll do that next time. The average interest paid, because we're borrowing from day one, has been 3.81. So the spread is the difference between what they're earning and what they're paying, 3.92. So on the money that the investor put in, they're making 7.73. And on the money the banks put in, they're making 3.92. They're making money on other people's money. This is a big part of Kaizen and why it works. We got some interesting stat here. NIW back tested this strategy to 1930, a long time ago. There has never been a 15-year period of time with less than a 2% spread. Averaging 2% plus since 1930. So you mean I'll probably make 2% at least on my borrowed money, maybe 3.92. Maybe it'll go up from there. 2%. Of course, in a negative return year in the market, that negative 20 or whatever, you get zero, but you still pay the 3.81. So you'll have individual negative years just from the interest. But over a 15-year, any 15-year period of time, minimum of 2%. That's really cool. The trust. So we call it a master trust. The payments are coming from all the people in the trust, and we actually set up a personal trust for all of you too. And the master trust is doing the borrowing and doing all that work for you, and gives you that creditor protection. Okay, you've seen this slide. We had those numbers before. I'm going to show you how Kaizen has performed. I think this deserves a drum roll, please. And I even did a curtain call. Kaizen would be giving you 90,000 income. Same return, different strategy. That's more than double the 37,000. Not quite doubling the 47,000, but that's 50, 60, 70, 80, 40,000 plus more than the 47,000. And so you had a lot more income, and you had initial death benefit day one of $1,438,000, and you still have death benefit of $1,132,000. You still have death benefit, and it could keep on paying income if you live beyond 95. That's pretty cool. That's what Kaizen. This is the alchemy I've been talking about. With lower risk, more income. Now, there's two periods of time in the United States history that are pretty unique. The Depression, the 30s, and then there's the 1980s high interest rates, very high. Whew, I remember them. You remember them too. From 1930 to 1932, stock portfolios lost 70% of their value. Did not recoup that loss until 1959. What we've done in this stress test, we've simulated 9 years of zero. Notice no negatives over a 12-year period of time. How's it doing? With this caused Kaizen to fall apart. About the 1980s, loan rates got as high as 16.88%. So we simulated high interest rates. Well, here's the numbers. I didn't give you a curtain call this time. The stress test of the 1980s, 67,500. Oh, we're still way ahead of 37 and 47, 20,000 over the 47, less than the 90. And the stress test of the Great Depression, that might have been the worst, 58, that 10,000 over the 47,000, still alchemy if the worst happens. That's pretty cool. And I did a curtain call here. So here, what am I doing now? I did double. Oh, come on, Jim. Kaizen, Allianz, get my names right. Allianz, one of the vendors, insurance companies we use, did a study on NIW's software, ILIA, illustration software. And they wanted to see how accurate these numbers are. And with this study, they said, okay, we think they're pretty good. In fact, we think there's an 80% chance that that 90,000 will be double. 80% chance of a double. 80% chance of a double. Wow. So maybe 58,000 on the worst scenario, maybe 180,000 on the best. Maybe using that 6.45 return, 90,000. Wow. Alchemy. And here's our final summary page. We added leverage, cuts capital outlay, don't have to put as much money in, prevents 5-year payments, prevents payment fatigue. Do people get tired of paying life insurance premiums for life? Oh, yeah. Most people drop them. Trust ownership, reduce liability risk. Turnkey, reduce complexity. Liquidity and flexibility. Easy access to cash flow, no RMDs. I should say improves future accessibility, not for the first 15 years. Oh, is that a problem for you? Then don't do this. Don't do this. This works wonders for those who stay with it. We're wrapping up now, getting to the end. There's a 7-point risk matrix built years ago. It kind of lists the things and what the risk is. Risk number 1 is risk-free, FDIC insured savings. That's understandable. Low risk is government bonds. Even the government who spends so much money. I've left off the ones in the middle. The extreme risk is cryptocurrency, option trading, startups. 6, high risk, private equity, speculative real estate. Well, 3, 4, and 5. Where's Kaizen going to fit in those 3? Well, let's show you. Moderate to low risk, the 3 spot, high quality corporate bonds, annuities, Kaizen. Lower risk in a balanced stock portfolio, lower risk in stock heavy portfolio, premium finance. That's where Kaizen fits. We have 2 landing pages that are quite amazing. This landing page, you don't need to give me your firstborn child to have access to this. You don't have to give me your cell phone number, your social security number, your email. I don't need to know anything. There's the QR code to go to this landing page. This is a wealth treasure It has videos. It has chapters, 10 chapters. It explains every little thing about this. Great resource. Take a copy of that QR code. And when you're ready to call me, even if you just have questions, do so. It's the place to start. The second one is one specialized. It's still Kaizen, but it's for those who want to gift this Kaizen, who's gifting this to a son or a daughter, or a grandson or a granddaughter. It's Kaizen with a gifting slant. I don't have a QR code on this. I'm sorry. Maybe I should make one. Anyway, if this is what you're really interested in, just email me, text me, whatever, and saying, give me the code for this landing page. And I'll send it to you and let you explore on your own. It has the same videos and everything you ever want to know about gifting in Kaizen. My website. I'm pretty proud of it. I got a great webmaster. It has a lot in it. I have a lot of quick links that you can look at stuff and learn. And I've got a retirement income gap calculator that I built that is very easy. There's a basic and advanced. You put in your age. You put in the age you want to retire. You put in an inflation rate you think it's going to be what life gives us. You're going to say, what percent of my retirement income do I want to have? How much have I accumulated? What return do I expect from now to whenever? And at what age do I want this to make sure it lasts? 95 in this example. And it'll crunch out, compared to what you have, your retirement gap. So in this example, it projected your retirement income need is 285 from what you have accumulated with no additions here. It can give you 129, so you have a gap of 155. With that information, I can help fill that gap. I can design a Kaizen, how much a year you need to fill that gap. The advanced calculator, which I finished fairly recently, obviously it's more advanced, a little more complex, but it looks that those numbers look pretty upsetting or whatever. But it adds in what you're saving, but your additional what you're putting in now, and if it's in a traditional IRA or a Roth IRA, and it spells out the same thing, what your gap is. Do the first calculator first. Then if you have any difficulties with this one, give me a call. So there we are. Oh, shoot. I took 40 minutes today. I apologize. I try to do this at 30. There's the same QR code again. And with the 40 minutes, I don't think I'm going to try to answer any questions, but I'll just let it go there and let you have a great rest of the day. And I try to do these webinars once a week. And I changed a few things this time, and I plan we'll probably see a few changes every time I present it, and I'll update the numbers and whatever. Anyway, you send your friends to me if you think they'd be good for them, good for you, good for anybody. Send them over. I'm happy to have them see the webinar. Talk to you later. Have a great day. Bye.